Morning, everybody. This is Brian Fielkow. It's so good to see you. This is our fourth event, and we're very excited as an organization to provide more than trucking, to be a thought leader, to give you advice, to help you see what we're seeing, so that we can be as smart as possible navigating the supply chain together through these unprecedented times. Everything at Jetco continues to move along. We've been fortunate to be very busy. We could always be busier, and so we're very glad to engage, to talk to you about any new opportunities you've got to, help our valuable clients stay competitive and stay creative and stay ahead of this market. Sitting here in Houston, I guess the one if I have to make a quick editorial, we were planning to staff our office up to 50% capacity. We've been doing a great job working remote on July 6th, and the numbers in Houston are just going the wrong way in terms of hospitalizations and positive tests. So we're delaying that until August 3rd. And my reminder would be, let's keep our distance. Let's beat this thing. Let's keep the curve flat. It's certainly not going in the right direction. We got to get COVID managed before we can talk about a healthy, sustained economic recovery. So I think it's important that we all just keep focused. I was talking to our attorney the other day, our labor attorney, and he said that in the past 2 weeks he's gotten more COVID-related calls from his clients than he's gotten since March. So he's seeing just a crazy uptick. Everybody is. Our drivers, whenever they can't distance, they've got masks with them at all times. If you've got special needs at your facility, COVID related, we're ready. We're working on, and we're going to be launching very soon, our own electronic bill of lading to avoid drivers and your shipping and warehouse personnel from having to get too close. So we're thinking ahead. We're trying to stay ahead of the game. And that brings me to today. I am thrilled to have with us Craig Fuller, who's the CEO of FreightWaves. And, several years ago, there wasn't FreightWaves. Today, in a very short period of time, 3-4 years, FreightWaves has taken over the industry as the leading information source. It's an amazing organization. If you're not on their mailing list and not getting their information, really make sure you sign up, because it's a wealth of knowledge. It's all out there for us, whether you're a shipper, a forwarder, intermediary. That doesn't really matter what you do. FreightWaves has information for you. I'm going to turn the microphone over to Craig. Craig is going to tell us a little more about FreightWaves. He'll further introduce himself. And then we're going to have after Craig has made his presentation, we're going to have a conversation. But I want you in that conversation. So I would point out there should be a place to ask questions. Should be a chat board that came up when you logged in. Make sure that you use that chat board. I'll be watching it. I'll be fielding questions. I've already got 2. And so just ask them anytime, and we want to be able to answer your questions. I've got this lasting about an hour, and if we we'll just kind of wing it, and I want to keep things as casual and conversation as possible. With that, enough from me. Let me turn this over to Craig. Craig, thank you so much for your time.
Hey, Brian. Super glad to be here. I appreciate the introduction. It's true we've only been around for a couple of years. It does seem like longer, mostly because in the world of startups, a lot of things happen really quickly. But a little bit about FreightWaves. We have journalists. We have a team that's about 50 on the editorial and media and news side. We publish about 40 articles a day related to freight, logistics, and supply chain. Really taking a market's view of freight. We often say that, or we're often called the Bloomberg of freight. In fact, Bloomberg calls us the Bloomberg of freight. So I'm not using a trademark infringement. That was something they coined. But effectively, what we're trying to do is bring data and context to the freight market using both unique and proprietary insights and data sets, and then we use our journalists and analysts to bring context to that data. So 99% of the people that we interact with on a daily basis through our site, through our TV product that's over the top streaming, don't pay us any money, and so a lot of the content we put out is free. But where we really focus commercially is really our data products is how we make our money. But really, most of the content we put out is free. But what we've tried to do is bring in some top-notch journalists that are able to editorialize and tell stories about the data that we've got, and then folks that have firsthand knowledge of how freight works, and can tell you where the bodies are buried in the industry, but also have firsthand knowledge of why some of these things are important that are happening. Certainly in the last 12 months, there's been a lot of stuff that's taken place that's really disrupted the freight market. Last year, trade policy was all the rage, if you will, and sort of the state of the industrial economy and the question of whether we were headed into an industrial recession or whether we were going to avoid that. My view, and I can talk about this through a little bit of data, our view was that the freight market was slowing down really from October 2018 to really, it started to ramp back in about mid-year last year. Mostly on the retail and consumer side. And I think people going into 2020 were pretty optimistic. We certainly were optimistic about sort of the state of the market, and then COVID changed everything. One of our journalists who's been with us for 3 years, as one of our most popular journalists, does a really good job, John Paul Hanstead, JP, commented to me a couple of months ago and said, it seems like ever since we started FreightWaves, or we're in FreightWaves, there's been so much happen, it's unprecedented. And that's true, but I reminded him that I've been in this business for really my whole life. I grew up in the business. And certainly when I started my professional career 20 years ago, there were things disrupting it. It was just different. There was Katrina, there was the hurricanes in Florida that hit and battered the coast. There was trade policy issues, strikes. Freight and logistics is constantly under duress and under stress, and our job as professionals in supply chain is to respond to these events. And so what FreightWaves' goal is to provide data and context for what's happening, hopefully that we can inform the market. We don't match freight, so we have the fun of sitting back and playing money-boarding quarterback to all of the professionals out there, hopefully giving them context for what's happening. But we're not on the field. In many ways, we like to say that we're a Bloomberg meets ESPN, where we get to play freight casters and sportscasters and talk about everything that's happening, but don't actually have to take the field and do the hard work. So, Brian, excited to be here. I've got a couple of things we can dive into, but I wanted to make sure I like a flow of questions. So happy to go into topical questions that are on everyone's mind, and dive into anything that's of interest to everyone here.
Well, Craig, maybe if we start with just a few thoughts, give us your overview, your sort of crystal ball of as to where things are going right now.
Yeah. So, Brian, can you see this? Is the screen visible right now? This.
Yeah.
I've got our data product Sonar up.
Yeah.
I don't know if you guys can see that.
Yeah.
But I wanted to dive in because I think
can't just send a message, but yeah.
So what I'm showing is some of our Sonar data. Now, Sonar data, the way that we have a couple of hundred sources of data that we put out, and we've got over 1,000 types of data sets that so what we do is we go to TMS companies, companies that are electronic in nature, and we get what we call exhaust data. So basically, this is anonymized exhaust data that comes from these systems. And one of our sort of benchmark indexes comes from tenders. Tenders are basically EDI or API transactions that go from shippers, often to carriers, sometimes intermediaries, but basically it shows us the resilience of the routing guide and where things are at. The reason I like this data is it basically comes within 24 hours, so you get to see real-time stats, and it's not skewed by load board activity or search activity, which is really, before these data sets were released, was really about the best you could get in terms of near-time analytics. But this is actually, from tenders, is actually on the front end. The reason I look at it is a couple of things. One is it tells us what's happening with volumes and demand And then we also can see supply. So the reason I want to point this out is everybody's trying to figure out what's happening with the economy, and specifically, is the economy rebounding? When will it rebound? And is this sort of a short-term blip? Any sort of resumption of activities? Brian, you mentioned earlier in your remarks that Jetco is wanted to get back in the office and then realized that that wasn't plausible, and we're doing the responsible thing by your people as well as the market by not having your folks in the office to the degree that they were because of the outbreak, and so this has certainly sapped a lot of consumer confidence. But the reason we look at volume data is it tells the truth of what's really happened in terms of demand. And so I want to point out a couple of things. So on this chart, I've got basically 3 years of data that I pulled up. The data set goes back to really February 2018. So you can see this orange line is the 2018 market. This green line would be the 2019 market in terms of freight volumes, and this blue line would be this year. I think this is interesting because it gives us a sense of where we're at in the cycle. Now, if you looked at Wall Street and looked at the stock market, and a lot of people have concluded that the stock market has ran away versus reality. I don't share that sentiment. I actually think the stock market, while it isn't directly matched to fundamentals, is telling us that the economy is more resilient than what most people want to believe or currently believe. And the reason I say that is when we look at the freight volumes, this measures volumes on we have an index based at 10,000. What it's actually measuring is comparing, sorry, it's not March 2018, it's March 1, 2018. It's comparing volumes from March 1st, 2018 as a baseline to where they're at today. And so the last paint, the past 24 hours, today's number is 11,860. So what that means is that freight volumes across the entire US trucking market are basically up since March 1st, 2018, around 18%. Now that's pretty remarkable if we think about the fact that 2018 was the record year in freight. So what we're actually seeing, and you can see it through this blue line, is that the freight market has actually started to accelerate as we came out of Memorial Day. We saw a lot of activities accelerate, and it's not slowed down. And so we're seeing higher acceleration in volumes vis-a-vis 2018, at higher volumes than certainly 2019, which was a relatively soft year. Now, if we go back and look at the COVID surge in early March, which was about the time that the supply chain started to react, companies were starting to see higher demand for certain types of items. The West Coast was starting to, certainly the state of Washington and California were more reactive and responsive to COVID than the rest of the country. And so a lot of the demand, sort of this breakout, if you use a term from Wall Street, happened in early March. And we saw an acceleration in volume of about 31% above that early March number. And then we saw the crash that took place on March 23rd. Now that crash was violent. I think everybody in freight and probably the economy knows how violent that crash was. But we saw it bottom out in about mid-April and then started to resume. And the reason, so in mid-April, I actually had come out publicly and talked about how bullish I was in the recovery. I was one of the first people to be bullish. In fact, some of the analysts inside of FreightWaves openly and publicly disagreed with my sentiment that I was more confident in the recovery than the broader market was. And the reason I came to that conclusion is about this time in mid-April, my view was that everything that was going to be shut down was shut down. In other words, the parts of the economy that were going to be impacted by COVID were going to be basically that was as bad as it was going to get, at least in this wave. And I don't think we'll ever go back to this sort of draconian shutdown in the economy. I think it will come in different stages and stuff, in different municipalities and states, in certain industries. And so because I viewed it that way, my assumption was that any volume from here on out that we saw, once we hit the bottom, we would see an acceleration, and that would be the low. And that's exactly what we saw. Was from mid-April on, we've seen, and this big dip here is Memorial Day, so just that's a sort of a holiday anomaly, and you could sort of see how it dipped and then resumed. But from that point on, we saw an acceleration in volumes. And in fact, so much so that normally this time of year, you would see this June acceleration to about mid-month, and then you would see it sort of slow down. We haven't currently seen that. We actually haven't seen the eclipse in volumes. And what I think is driving that is this sort of pent-up demand in the economy. And frankly, so much money coming from the Federal Reserve and the federal government that's flooded the economy with dollars that has helped the broader freight market sort of hold up. And so that is my general assessment of where we're at right now. I would say moving into Q3, third quarter, and fourth quarter, I'm actually extremely bullish. One of the things that not only talking about freight, but talking about dollars is that in the month of April, the amount of money that was deposited in bank accounts was $860 billion. That's the largest growth in balances in bank accounts in the history of the United States. In fact, so that $860 billion in growth of bank deposits was higher than it was in a single year. And so what's happened is the government has flooded the economy with so much money, and that money's ended up in bank accounts that's yet to be spent. I think people are holding on to it until they can get a more normal jobs and careers and sort of resume life, that at some point that money is going to be spent. I mean, one thing about the American consumer is you can always count on them to spend their money. And I also think, as it relates to freight specifically, is the certain types of activities that consumers would be spending money on in the summer are somewhat on hold. So we're seeing sporting events. The summer is sort of a small sporting cycle, but certain people aren't spending money on event tickets. They're not going to concerts, festivals. They're not going to movies as much, and they're not eating out as much. But those things don't move a lot of freight. And so because they don't move freight, they're spending money on things that do move freight, like going to Home Depot or Lowe's or going to Best Buy, or Restoration Hardware has had a blowout, has actually had done really well. People are furnishing their homes. They're doing things that are driving freight. And so I'm really, really bullish about the state of the freight market, because I think we're seeing higher demand than expected, and we're seeing higher consumers are doing better than those unemployment numbers are suggesting. So I'll pause there, Brian. Happy to dive into specifics as it relates to sector specific. I know you guys do a lot in the oil fields, and the energy sector is important, but I wanted to make sure we answered the questions of the folks.
Yeah, let me come back to you on capacity. It's interesting. Whenever we've talked to our clients, we've been equally bullish, but for different reasons. In other words, the position that I've been taking, just kind of seeing what I see and reading the tea leaves in our world, is this: that even if the recovery, even if the economy generally does not have a V-shaped recovery, trucking can and trucking will. Because, in 2019, you had over 800 trucking companies fail. There's been failures into the COVID era. The insurance market continues to be extremely challenging. All that's to say, in addition to demand, you've got to look at constraints on supply. So the perfect storm, in my mind, is if we're both right. The perfect storm is on rates is the capacity remains constricted. Now, some capacity will come back. Furloughs will end. People can get called back to work relatively easily. But that doesn't account for company failures where not every truck that failed got reabsorbed. So comment on that for a minute. So you've established that you're very, very bullish on the demand side. I'd like to know, number one, am I reading it right on the supply side? And if I am reading it right on the supply side, so now if we're both right, the demand is going to keep pushing and supply is not going to keep up. Driver supply, truck supply is not going to keep up. if I'm a shipper, and there's a lot of shippers on this call, how should I prepare? What should I be doing the next 6 months, 12 months to make sure that I get the trucks I need when I need them?
Yeah, that's a great question. It's certainly, so I look at demand, so the freight market, whether it's pricing or capacity availability is really a function of supply and demand. So we've talked about the demand side, and demand leads the broader capacity. So trucking companies tend to, so demand will happen first, and then supply comes in response. The problem is they're not timed equally. So it takes a little bit of sustained volume or a while of sustained volume, anywhere from 90 to 180 days of sustained volume before you see growth of capacity. But oftentimes capacity overcorrects, and we can actually see that. So one of the indexes we track is our outbound tender reject index, and this is basically what we're tracking here is when trucking companies are rejecting loads that are oftentimes in their routing guide. So these are EDI or API transactions tenders sent over to trucking companies. And what this tells us is whether or not the trucking companies are accepting or rejecting those loads. Now, it's not tracking a lot of the spot market activity that's done through confirmation sheets or emails, because those aren't electronically typically transacted. What we're tracking is the tenders, which is really the first domino to fall, or the first thing that shows up in the routing guide, because usually what happens is shippers sort of have their default carriers on lanes, they tender those loads over, and then after that breaks down, after they get a lot of rejections or don't get carriers to accept their loads, then they resort to other means, including going to the spot markets. And so I look at this data as a way of monitoring capacity. And what this tells us is, if we argued, or I would argue, that volume was a V-shaped recovery, that capacity is more of a U-shaped element, or rejections are more of a U-shaped recovery. Now, what we're seeing is this violent move right here, which is violent in the sense that if you're a shipper, you're seeing a lot more rejections happen than you expected, and maybe you're seeing rates start to come up. Violent in the sense that if you're a trucking company, then you're benefiting from that. So the move is very, very, very drastic. And what this suggests is a couple of things. One is volume is now at a critical mass where it's absorbed all of the capacity in the market. Trucking companies are feeling more confident in their ability to reject loads, and they have other options to move their equipment. And so they're rejecting freight that's priced, that's either going to lanes that they don't want to go into, or priced at a level that they're not comfortable taking those loads. They can find alternatives that pay higher. Now, one thing you pointed out, Brian, you pointed out the degree of bankruptcies we saw last year, and I completely agree with everything you said. Now, one of the things we do, because we have a group of journalists, is we cover a lot of bankruptcies. But one of the surprising things is during the COVID crisis, with the exception of the oil fields, I don't think we covered a bankruptcy during that 2-month period. Now, that's surprising, because you think about volume dropping off, rejections dropping off, you would think that there would be a lot of bankruptcies. Now, keep in mind, when I talk about bankruptcies, we're not going to report on the 2-truck guy that shuts down. We're not reporting on the 5-truck guy. Usually it takes, before we'll write a story, about 25 trucks or more. We just didn't see a lot of those bankruptcies, except in the oil fields. And the reason that I believe that's the case is the PPP money, the money that was flooded to the government, to small businesses, kept a lot of those carriers that were on the brink of bankruptcy even before COVID alive, and helped them sustain themselves for a couple of months. Now, that's good news for those drivers and more importantly, the back office folks that were employed by those carriers. It's bad news if you're a competitive trucking company, because that capacity now still exists. Those trucking companies are still in the market. And so when we look at it, what we're seeing now is higher rejections, but I don't think we saw as much capacity churn out of the market as what one would expect. And that's why this tender rejection element, this is a percent of total rejections, 10.29% out of all loads were rejected across the country. That's why it doesn't match up to volume. So volume would in a market where you had equal amount of capacity versus demand, you would have a situation where as volume increased, rejections would increase. But because they're not equally matched, and we still are living with the hangover of 2018 in terms of excess supply entering the market, it's taken a while to sort of absorb all that capacity. But what you're seeing right now is we're seeing rejections increase. This is year over year. So we're looking, these are the 2018 numbers in rejections. That's why the spot market was on fire. This is also when we saw a lot of new trucks enter the market. This was 2019, this yellow line right here. Last year was a pretty tough year for a lot of trucking companies. They didn't have pricing power. Shippers were demanding rate decreases, and we were able to find alternatives at a cheaper rate than probably they had in their routing guides. So carriers were accepting most of the freight they were offered. We saw this surge happen during the COVID crisis as trucking companies were responding to this massive amount of demand, and also just the health elements of their own staff. And now what we're seeing is about it was really Memorial Day, was this breakout where the 2020 numbers in rejections were higher than the 2019 rejections. And so what we're seeing right now is this element where rejections are starting to increase. Now, one thing that's not really factored in this is two things that you mentioned. One is insurance. Insurance rates have been, particularly for carriers that have less than stellar records, insurance rates have been on the tear, particularly for some of the premium policies above the basic $1 million or 700,000. And so that catastrophic, those catastrophic policies have taken massive increases. But what we found is when we surveyed and talked to a lot of insurance brokers is a lot of the states and some insurance companies did not require the carriers to pay their insurance bill during the COVID crisis. So they basically gave them 2 to 3 months of not collecting money on their insurance policies or deferring the payment on their insurance policies, which meant carriers had sort of a lifeline that they were able to sort of fight another day. That also is true in the financing department, is that a lot of the financiers in trucking were not foreclosing on their assets if they weren't paid. They were giving some leniency to their carriers to work it out. That makes sense if you're a lender. You don't want to take a truck off the road and put it against a fence in that crisis. And so those elements help buoy or provide an artificial lifeline for a lot of the trucking companies that may have been struggling. Now, one other thing that's in this is the hours of service rules had been changed in early March to allow carriers to have flexibility on hours of service. And let's remember that the capacity constraint is not the number of trucks. It's really the number of drivers times the number of hours drivers are allowed. And when they changed the hours of service rules, they said it's for COVID-related crisis elements. But let's just be honest here. Drivers, because it was so broad, drivers and carriers were pretty liberal in their interpretation of what that meant. And so because of that, effectively, hours of service rules were not really enforced for those 2 months. And the carriers knew it. And so they took the opportunity to stay out a little bit longer, make a little bit more money, and do good work. And what we saw was this, and frankly, there was no traffic. That also helps. And so what we saw was this sort of excess amount of capacity that is now being absorbed.
Great. I mean, that's really helpful. I think, again, as a shipper, I can't urge you enough to watch these trends. You know, it's going to be uneven. It could be regional. It could be certain lanes get tighter faster than others. But you know, again, the key is to watch the trends and you know, stay ahead of it, because it's important that you have good quality trucks when you need them. And I would look for, I think this year is going to continue to change. And I guess I just would share Craig's Craig's bullishness and overall that there's going to be more upward pressure on rates than there's going to be downward. Even if the economy does sputter, which it probably isn't going to, that the trucking economy probably won't sputter because of demand for trucking and maybe some of the capacity issues. So that brings us to those of us calling in and dialing in from that's old, logging in from Texas. How is energy going to impact freight? How's it going to impact trucking? What's your take on those of us living in the energy economy?
Yeah, I mean, look, if I knew how to trade energy or could predict the future of energy, I probably wouldn't be in freight because you'd make a lot of money. It's the world's most liquid commodity. I'm not going to speculate on the direction of energy prices, except to say, I think much like most of what we've seen with COVID is the worst is behind us in terms of oil demand. And frankly, there's going to be a supply constraint simply because the price of oil is not at a point, and there's not enough confidence among companies to capitalize new exploration and development of oil supplies, particularly in North America. So it's going to make it much more difficult, and I think it's going to put some capacity constraints on the oil market, which means we're going to have firming of prices. And so, having said all that, oil is a net positive for the trucking market. Oftentimes, people outside the trucking market that don't understand depths, and frankly, a lot of people, my dad, who's been in trucking his whole life, would always argue that when oil prices go up, it sends the U.S. economy into a recession. That actually isn't the case over the last couple of years because oil is so tied into the industrial because of fracking and domestic production acceleration. Oil is a net positive for the freight market, particularly in the flatbed side of things, and particularly in parts of the economy like Texas and North Dakota and such, that when oil is down, that actually impacts the industrial side of the economy. And so because of that, there's going to be certain parts of the freight market that are going to take longer to recover than the broader side of the market. So the dry van market, I'm extremely bullish on. The reefer refrigerated market, I'm incredibly bullish on, and it has more to do with the change in the way that people are buying groceries and eating at home, and the disruption to supply chain versus restaurants. I mean, one thing that I don't know is what as well understood is that the restaurant supply chain and the consumer supply chain are actually quite different. The Sysco's of the world, I know in Houston, shout out to the home team, Sysco. The Sysco's and the McLean Foods and such, they're running almost milk runs in terms of their businesses, their U.S. Foods, et cetera. They're not doing a lot of the ad hoc grocery type runs that are irregular or, they run these things on scheduled routes. And so, and they have an entirely different packaging system and supply chain. And so when the demand moved from the restaurant sector into the grocery sector, we saw this massive increase in demand in the grocery sector for over-the-road, for-hire trucking business, while we saw the restaurant sector completely capitulated. Now, it's true that Sysco's and U.S. Foods moved some of their capacity to handle grocery, but their networks, their drivers, their trucks, and are not built to do that long term. They were just trying to keep the drivers running. Long term, the U.S. Foods, the Sysco's, and McLean's are not well positioned for that for-hire market, and so they're not going to really absorb a lot of that demand in cold chain. And so that's something of interest to watch as well. So that's going to be a lot more for-hire freight that we'll see. Now, one of the things that I'm bullish on flatbed is not about oil, but more to do with construction. Is if and I believe right now, every week, this being an election year, let's not forget that every week there seems to be another $1 trillion bill in front of Congress. And one of the ones that they talked about was this infrastructure bill that was right at $1 trillion. They're talking about basically massive building building construction. And if that happens, and I think I'm pretty optimistic that it will, simply because I think the Republicans and Donald Trump specifically want to stay elected, and Donald Trump has no problem spending money on big projects. He loves construction, so let's not forget that as well. My guess is that we'll see a big infrastructure bill this year, and when we do, there'll be a lot of demand hit the freight market because those things have to move. The good news is that's not short term. These infrastructure projects play out over a decade or so, and so we'll see a lot of demand continue to accelerate, and that will firm up the flatbed business.
So that's interesting. So you think that even in a very highly contentious election year, that the Democrats and Republicans will get an infrastructure bill done before the election?
I think it's. I mean, look, I'm not a political expert, so your guess is as good as mine. But I've seen the fact that in this cycle, I think in terms of between the Fed and the U.S. Congress, I think we're up to something like $6 or $7 trillion, which is something like 8 times what we saw during the TARP money and the financial crisis. There doesn't seem to be a concern about the deficit, and I think there is a broad desire to pump a lot of money into the economy to keep it afloat. And they're hiding under the COVID, and rightfully so. I mean, the good news is they reacted quickly and probably saved us from a really, really dramatic downturn in the economy. But having said that, I think they're also going to use this as a chance to get a lot of their pet projects. They don't want to end up with high unemployment or economic issues in the fourth quarter going into the election. You asked specifically about Texas. I mean, look at how big this is. OTBI in the state of Texas. The Texas volume is on a tear as well. So it's not just related to oil, but we're seeing a lot more volume out of the state of Texas than what we saw really any time last year.
So one of the questions, I think you sort of answered it, but I just want to kind of press for a little more clarification, which was outlook into the break bulk market, which is obviously huge in Texas. So break bulk, flatbed, and I think probably when we think about break bulk, we're going to think a lot about energy, wind, your typical break bulk cargoes. Bull or bear?
I mean, I'm bullish anything that requires big dollars from the federal government, and the energy incentives are there. I would say, the issue is that long-term trends. There's an awareness that, look, here's how I would say it is the hydrocarbon is the most efficient way to deliver energy, but the problem is there's a lot of downsides to that because of the emissions. And I think what we're seeing is younger generations are really mandating or demanding that the government invest in alternative energy projects or clean energy. And particularly in the offshore wind market, where you don't deal a lot with the issues around environmental bird constrictions or migration that you do on onshore. And the technology such has come in the last couple of years that they can actually have these floating, they can go deeper into the ocean with these floating pavilions for windmills. I think we're going to see a desire, more investment in that long term. Now, in the last couple of years, we've seen a sort of a backlash of solar incentives, particularly in the residential market, happen. But I think the long term, it's hard. As an investor, you don't want to really bet on clean energy because that's fraught with there's been a lot of people lose money. But I wouldn't, on a macro trend, I wouldn't bet against the government, particularly, regardless of where this election cycle ends up and who has control. There's going to be a lot more desire across the country, whether it's at the state level or federal level, to invest or support these energy speculations around clean energy.
Okay, I've got another question coming up here, and remember everybody, if you have questions, go ahead and put them into the box, and I will look at them and read them. So the next one has to do with supply chain shifts, right? So if we take the political rhetoric and put it aside, right, on China, trade war, we also learned during COVID that we may have been too reliant on any one part of the world or any one country. So in addition to the increasingly tense political situation between the U.S. and China, what we've learned about COVID, is just in time going to be the way that we manage our inventory in the future. How does Mexico come in? Where do you see the major supply chain shifts? And what should shippers be watching, and how should they be planning their supply chain based not just on the political environment, but on COVID also?
Yeah, this is an interesting thing. I think a lot of I set Jerry Yang, the CEO or the founder of Yahoo. I watched him speak, and he's politically connected, but also has a pulse on sort of the political environment in relation to China-American relations, because he's a Chinese American that's had a lot of success in Silicon Valley. And I watched him talk about this topic of particularly China and trade. And he said China is the one topic that both the Republicans and Democrats largely agree on. Now, they have different reasons. The Democrats talk a lot about the humanitarian violations of the Chinese, their reckless environmental policies, these elements, and so they're anti-China for different reasons than the Republicans, where the Republicans are much more focused on trade issues, but or around business and competitiveness and perhaps nationalism. But the battleground is fought around trade, and I thought this was interesting because it suggests that regardless of who's in office, that the China-America friction is going to be a more permanent fixture of our country and our political system. And what it means is that companies that were dependent upon doing all of their production in China are going to have to look at alternative sources. And so that's sort of the economic thing, because you end up in a situation that the biggest risk to shippers, manufacturers, or retailers or wholesalers is the disruption to their supply chains. And so to mitigate that risk is they're going to look at sources that are much closer to home. It doesn't mean that manufacturing is going to come back necessarily to the United States, but it probably means that places like Mexico, Central and South America are going to see more demand. Manufacturing that's not heavy on human capital, but on more technology centric, that doesn't have massive sort of low skill jobs, probably will come back, and we'll see domestic sourcing. But I think suppliers and shippers will start considering domestic or nearshoring sources more aggressively than they ever did. And it's not because of just trade policy, but it's because of the COVID crisis and what it did in terms of shocking the system. Now, this isn't just my view. The CSCMP and A.T. Kearney did a survey of shippers, and they said that nearshoring has been talked about for the past decade, where it's mostly talking points, because there was never any action. It was all sort of people making predictions. What they said was that in their latest survey, this is the first time they actually saw companies have we're making finite decisions and results of nearshoring. And so I thought that was interesting, is that's a trend that we'll see. And again, that's good for freight, domestic freight movement, because it means that there's less container volume coming overseas and on rail, and it will mean more production in the United States and in Mexico and Canada.
Let's talk about.
And one last thing is regardless of where we end up in the election cycle, and regardless of whether we're talking about China or Mexico, is when countries are exposed. I mean, yesterday I saw something where the EU is now talking about not letting Americans travel overseas, is because of COVID. It's also political, probably as much as anything. I think domestic sources, you have to have at least a domestic alternative if you don't have a primary.
Yeah, I'm sure the EU is glad to point out how we're doing managing COVID and saying, well, you you did that to us, and get your act together, and then we'll but again, I still believe we're in an international economy. We're going to continue to be an international economy, but national interests definitely seem to be playing in more and more, and it sounds like that's going to continue, and you got to kind of follow where the freight trends are and where the supply chain trends are. Maybe a month ago, maybe more like a month and a half ago, when we were sort of in a trough, there was a trucker broker war, right? I mean, there was a lot of rhetoric between truckers and brokers, and I guess my view of that war was that there was a lot of fighting over a pie that shrunk overnight. But as that pie returns to normal, do you really see this trucker broker war as having legs, or was that like a short-term distraction, during the depths of the COVID freight cycle?
Well, I mean, there's always this sort of tension that happens between the carriers and the brokers, and the reasons come down to the economics. First of all, I think trucking broadly, because the market's so fragmented and so big, that these stories can sort of take hold in them. And so I think what we had was the news cycle. There was a lot of economic stress on the carriers when volumes were completely shrunk, and I think they were looking for somebody to blame. And so they were assuming that brokers were making a lot of money when there was a moment in time where brokers' margins expanded rapidly, simply because of the differential between the contract rate and the spot rate. The spot market fell out from under when we saw volumes fall out from under the market, and what that basically meant was that spot rates were falling faster than frankly the volumes did. And so what ended up happening is a lot of brokers' margins expanded. And I think what that ended up doing was really highlighting this stress that happens in trucking, is that most trucking companies, it's an interesting stat, 85% of the profits made in trucking are made by brokers, not by the trucking companies. If you looked at all the deal, trucking is a very difficult business if you own assets to make money. And I want to point out, this is operating ratio. That if you don't know what operating ratio is, Brian, I know you do, but the broader audience may not be aware what an operating ratio is. This is the opposite of profitability. And so anything above 100 means that the company's losing money. And so this is taking from the TCA's data, the Truckload Carriers Association's benchmarking program. There's about 220 fleet profiles that feed into this, about 70,000 trucks. And basically what we're looking at is, in the last year, is for the most part, the trucking market lost money. Now remember, at 100, they're not paying their loans on, they're not paying their debt off. So it's in many ways, and I'm not talking about truck debt, I'm talking about their working capital debt. They need to break even. Most carriers need to be about 97.5. It's not sustainable anything above that. And what we saw throughout the last year is basically this entire last year, this is 2019, is the truckload industry lost money. Now keep in mind, these are 220 fleets that make up 70,000 trucks. Remember the TCA, I think the smallest fleet in this is something like 25 trucks. The average is 300 trucks. These are guys with infrastructure, or guys and ladies with infrastructure. These are real carriers of substantial scale relative to most owner operators. And as for the most part, they lost money. They simply lost money. That stress was building over the past year. And what we saw in April was this sort of reaction to and lash out between the small carriers and the brokers. And really, it was an OIDA TIA fight, because OIDA was looking for somebody else to fight. They weren't fighting the ATA. Didn't make a lot of sense, in the sense that all the truckers were so united. So they ended up going after TIA. I think part of it was to sort of show that they're responding to the pressures of the market and trying to find someone to blame, and brokers became an easy target.
Yeah, I agree. I think it goes away. I think the TIA could have handled it a lot better.
Well, their president is no longer a part of the TIA. Bob Voltman has stepped down.
Yeah.
I don't know. I don't have all the context of whether that was because of it. It certainly didn't help his case in terms of staying in that role.
Yeah, I agree. I mean, I think ultimately it goes away. I mean, truckers and brokers both have a critical role in the supply chain. I don't really see that changing. But again, your point, if we look at this graph you've got up about, kind of where the operating ratios are, I mean, one of two things is going to happen, or both. Either you're going to see more trucking companies fail, or you're going to see rates go up so that truckers can, make a reasonable profit. But this isn't sustainable to operate as an industry at a loss.
No, I mean, look, the rates on, and you know this, Brian, and I think most people are aware of this, is that rates don't go up in a vacuum. I think shippers are rightfully are right to chase rates on the downside when they have the opportunity. They're right to reallocate capacity or reallocate demand. The problem is that most trucking companies don't make money. It did not make money last year. And when there's long-term sustained rates that are below the cost for most carriers, that isn't sustainable long-term. So what we're going to see is a lot of failures you mentioned failures earlier. We're going to see it take place over the next couple of months because a lot of that economic damage, even though the lenders put money on hold and the insurance companies put money on hold, they're going to start demanding those payments back. We're going to see a lot more failures in Q3. This is going to be what's going to be really strange is even when the freight market is accelerating, you're going to have a lot of failures because of all that working deficit that they were in last year, and now they'll have the chance to sort of bankrupt themselves. So
exactly, and the stimulus money, in the best world, the stimulus money was that lifeline that a trucker needed to get through COVID. At its worst, it was a artificial sense of security where you could be operating at below market rates because you had all the stimulus money coming in that you didn't have to pay back. So I still think the question becomes, will there be a day of reckoning where you've got to start running at normal rates and you don't have the stimulus, the PPP funds covering your payroll? And so you're right, at that point, you'll see capacity come off, and as capacity comes off, that's what will push rates up. And again, if I was a shipper, that's what I'd be preparing for, because I think it's going to happen. And now we compound it with your bullishness on the demand side. I'd prepare for it even more. We're about at time. I'll close with one question. If you're talking to a lot of shippers on this call, Craig, what's the one takeaway? If you've got a shipper saying, okay, how do I play the next 6 months, 12 months? What's the one thing you want them to know?
I think your point a few seconds ago is spot on. Is that I personally believe that volumes are going to be really strong, and I also believe that we're going to see contraction in capacity, which is remember, capacity takes a while to respond to new demand. The larger carriers and mid-sized carriers are reluctant to add trucks, so we're going to see this whipsaw happen where we're going to see, and we're already seeing it, volumes increased, tender rejections will increase. There's going to be a rash of bankruptcies that happen simply because of insurance costs go up. As you mentioned, the financing, those elements are real. And then we're going to see a massive capacity crunch. So if I'm a shipper, I'm going to be playing a defensive structure in terms of price. I'm going to be locking in. I'm going to be willing to accept rates that my preferred carriers are asking. And that doesn't mean massive rate increases, but I wouldn't be pushing for lower rates. Those days are over with. I would certainly be thinking defensive, and I would also be thinking about adding, broadening my carrier base if I don't have confidence that carrier can deliver. Last year, a lot of shippers enjoyed plentiful amount of capacity. They enjoyed the ability to sort of take advantage of lower rates. This year and the later part of this year, it's going to be the carrier's opportunity to pay back. And I certainly wouldn't want to be on the receiving end of someone that I I had used and abused last year because I think carriers are going to have pricing power this year, and I don't think we're going to see a surplus of capacity come back because I don't think banks have the appetite to lend money on trucks. I think we're going to have a labor shortage in the trucking market simply because the government stimulus, a lot of the food service and construction jobs are going to be there. And I think in the insurance market is going to be, I mean, whether or not this law, this $2 billion minimum passes or not, insurance companies are certainly going to be very proactive in improving underwriting based on safety quality because of nuclear verdicts and all that funness.
Yeah, and when it comes to underwriting, I mean, we have a lot of clients who, you know, are underwriting us as their trucker. They're underwriting our culture, our safety culture, as part of their carrier vetting process. Just like insurance companies are now underwriting, you know, it's more than just loss runs. It's safety culture, because, you know, a bad thing could happen to the best company in the world. That's a risk of being in this business. But the question is, do you have a well-defined, integrated, enterprise-wide culture of prevention? Because that's what's going to help you manage risk. It's not the shock loss that could happen to anybody. It's, are you set to manage risk? And we spend an inordinate amount of time on our safety culture and on insurance because we know just how important it is to viability and sustainability, and at the end of the day, your competitive advantage. So I think insurance is going to continue to be a big deal. I think shippers need to be aware of what's going on in the insurance market because, you know, we understand fuel goes up, rates go up, fuel goes down, that adjusts rates too. But people have to think about insurance the same way because the market is so firm. Truckers can't absorb some of the increases they're seeing, and it's going to keep driving some out of business. Craig, with that, this was a great conversation. I hope everybody on this webinar enjoyed it. I really, on behalf of everybody, thank you for your time and for just the incredible job that the FreightWaves does for the whole supply chain. So thank you so much.
Brian, appreciate that. I would want to say one thing to shout out to you, and I'm not saying this because this is your call, but kudos to you. I think you have been one of the more proactive public faces talking about culture, safety of culture, and really culture, organizational culture. And so on that topic, I think certainly Jetco, yourself gets a lot of kudos for being very proactive in having conversations at a time are uncomfortable for our industry.
Thank you. Well, we'll keep doing that.
Well, so. best of luck as we enter the rest of the year, and wish everybody check me out, FreightWaves. You can network me on LinkedIn, and appreciate everything.
Thank you.